the biggest picture thing I focus on over the past few years is this concept of the long-term debt cycle. And that was originally popularized by Ray Dalio. And one thing I did was, I would see his charts and see his explanations, and I said, okay, that actually answers some of my questions. But I want to go in and determine, is this accurate, and can I explore this from other angles, and how can I quantify this in other ways? And so I went, I spent a lot of time going through very old data sets, and reconstructing all sorts of historical, fiscal, and monetary, different ways of measuring debt and monetization and inflation and fiscal deficits, things like that, interest rates. And I built this big data set that I then used, which formed my macro thesis that has been extremely helpful over the past few years, which is basically extending and deepening that long-term debt cycle thesis. And the short version is the idea that, we always think of these short-term business cycles, these 3 to 10 year credit expansion and contraction cycles. And I think the important insight there is that because policymakers can come in and respond to when there's a credit contraction, they can cut interest rates, they can do fiscal stimulus, depending on if we're talking about fiscal or monetary authorities. The point is they purposely kind of short circuit that deleveraging process, and then they try to get that credit growing again. And generally what happens is when you string a bunch of those together, instead of like a sine wave of credit expansion, you end up with like an upward sloping sine wave. So you keep getting higher and highs in terms of debt GDP, and then you get lower and lower interest rates because now there's more debt in the economy and there's kind of that more downward pressure on the rates. And so you keep kind of building up more and more debt. And so that's what you call the long-term debt cycle. It goes through multiple cycles over multiple decades. And the problem, of course, happens when you get so much debt in the system, and then you run into the zero bound, or in some countries even mildly negative interest rates, and then there's really no further to go to allow that engine to keep going up. And then you start to get, this happened in 1929, into the 30s, and it happened again during the global financial crisis. If you look back in terms of financial metrics, those were very similar. Like in terms of, for example, how much bank loans there were in the economy compared to the size of the monetary base, right? So you're basically your multiple on different types of money compared to deeper into the stack, and how much credit risk you're taking on when you have that type of levering, combined with, of course, speculation, either on stock market or houses, depending on the environment. And when that all unwinds, that's a private debt bubble that's popping. It's very disinflationary. Money's being destroyed because loans are being defaulted on. And you start to get kind of a fiscal response, right? So both in the 30s and in the 2000s, you had these ongoing fiscal and monetary responses to try to deal with that. And my observation was, a decade later is when you run into the other side of that crisis, right? So that part of the crisis is the private debt bubble, the disinflationary deleveraging crisis. But when you put all that debt onto the sovereign balance sheet, when you monetize it, when you go through this process, that has a number of consequences, right? So one is you again, like I said, you put it all on the sovereign level, but you also in both the 30s and the 2000s, you had periods of rising populism, right? So there's more and more discontent. There's basically this kind of a widespread understanding that the economy is not functioning well, and when they run into the next crisis, in the 40s, it was a lot of that populism turned into war, obviously, and here we had a very kind of still levered environment, high populism, slowing economy, ran into COVID, and now we have war. Both those environments, you generally get very, very large fiscal responses, right? Because it goes up to that level, and that's where you get that more inflationary or stagflationary type of situation. And so I've been making a lot of parallels between the 2020s and the 1940s, and as well as the 2010s to the 1930s. And unfortunately, that does continue to play out. And in some cases, it has even become more literal. Now that there's some degree of kinetic war happening. It's a different phenomenon because credit contraction on its own is more disinflationary. That's kind of what we've seen in Japan, for example. They've had money printing at like the sovereign level, but they've had significant deleveraging at the corporate level, both in terms of increasing their cash allocations and decreasing their debt level. So they've been a lot of it has gone towards net debt reduction, and that's been an environment of low money supply growth, and generally stagnation. Same thing for like the 2010s and the 1930s. You had a reduction in the amount of debt relative to GDP among the private sector. And so that's generally a more disinflationary environment because you have low demand for things, or at least slow growing demand compared to the prior trend. And the issue is that, one is that commodity cycles work themselves out over time. So those are environments of say, commodity abundance and low demand. And then the problem is over time, you work through those reserves that you've built. There's not a lot of, not necessarily a ton of new capex coming online. Demand is slowly increasing over time. And eventually you run into the next commodity undersupply cycle, which is generally a more inflationary cycle. And then the problem is you're now running into that environment when you have super high sovereign debt level, right? So you have that tension between you're supposed to raise interest rates when you have inflation, but now you have over 100% debt to GDP, and you have a very highly leveraged system, especially when you look out in parts of Southern Europe, you look at Japan, as well as here in the United States. And so that's where you get that more inflationary type of response, that financial repression, that more rapid increase in the broad money supply, right? So for example, in the aftermath of the global financial crisis, if you look at a chart of M2, broad money supply, nothing looked unusual about it because you had some money being destroyed from loan defaults, and then you had some fiscal response to shore that up, and they roughly balanced out. So you had roughly normal broad money supply growth, whereas in this type of environment and in the 1940s, you had that huge increase in broad money supply because you had very, very large fiscal monetized fiscal deficits, which is generally a much more inflationary type of environment. If you go back to the 1940s, I mean, that was a period where the Federal Reserve pretty much completely lost its independence for the better part of a decade, where it just capped yields, much like what Japan is doing now. In the 1940s, the Federal Reserve capped long duration treasuries at 2.5%. They capped the short end of the curve at near zero. And that was despite the fact that you had an average of about 6% inflation in the 1940s. It spiked as high as 19%. They were still holding rates in that like 0 to 2.5% band. Towards after the aftermath of the war, that's when you eventually separated them. That was after you had significant inflation relative to those interest rates. You had a period of financial repression, significant real losses in treasuries and cash, and we're kind of seeing a similar environment now, where the Bank of Japan's holding rates very low, despite the fact that inflation is above their target. You have the Eurozone's dealing with very high inflation, but they're still trying to manage spreads for those southern countries. Because you have a fiscal problem and a debt problem. We see the Bank of England come in. They're supposed to do QT. They had to cancel their the balance sheet reduction speech and start just kind of doing 2 weeks of QE, despite the fact that inflation is 10%, because they're trying to have not their bond market get disorderly and break all the pensions. We're seeing kind of cracks in the U.S. Treasury market. We'll see how that develops. But essentially, yeah, one thing that characterizes the end of a long-term debt cycle is a loss of central bank independence, and that kind of forced blend of monetary and fiscal policy. Because the reason we think of government bonds as risk-free is because we know when push comes to shove, they support them as needed. And so if you have generally whenever a country gets over 100% debt to GDP, it starts to be the case that historically it's very, very unlikely that those bonds over the very long run are going to be paid back in purchasing power terms. They're going to be defaulted, restructured, or inflated in some way. Now, if it's an emerging market where some of the debt is not in their own currency, that's where they're more prone to nominal defaults or restructurings. Where in a developed country where the liability is their own currency, that's usually when you have, historically things like gold depegs or financial repression, holding rates below inflation, where you essentially restructure or partially default in that way, where you pay every currency unit that's owed, but over the lifetime of those bonds, those bondholders do get a haircut on their actual purchasing power.